Hello, everyone. Good morning. We will start the webinar soon. Please bear with us. Thank you. Okay. Hello, everyone, and welcome to the INREV Webinar series. My name is Konstantin Sorlescu. I'm the Professional Standards Director at INREV. Today, we're going to discuss about the impact of COVID-19 on liquidity and pricing. For example, how is this pandemic affecting funds, their pricing and liquidity needs? And what are the options currently available to managers? We'll also be discussing about how to review your NAV and whether additional disclosures are required. And you'll hear that from some leading auditors. Now, we will be addressing this together with our speakers in the next 50 minutes or so. And just to note that this webinar is open for both INREV and AREF members, as we will also touch on the open-end fund pricing project. And this is an initiative between the two associations. Now, just to stress that the goal of the webinar is to provide practical insight and facilitate an open conversation around current issues and the options that members should consider in the best interest of investors. Now, our goal is not to prescribe guidance. So let me be clear, for guidance, you must follow any information or action or inaction, of course, required by your regulator. Therefore, what I would like to ask participants is not to use specific names in the question or the chat box or during the conversation, so we can have an open dialogue. Now, in terms of housekeeping, we'd like to have an interactive event, as I said, so you can submit questions using the question window, of course, and we'll try to respond to as many as possible during the Q&A slots. By default, you'll see that your mics are turned off, so I encourage you again to use this chat room, and you can also customize your view from your menu, so you can see who is presenting, for example. If you're missing the live session, this one, and you're watching the recording and you have questions, you can of course always send us an email at professional.standards@inrev.org. So we'll be happy to assist you with your questions. Now, please remember the session is being recorded, and we will provide a copy of this recording on our website after the live event. In terms of our other initiatives, let me just mention that we have a dedicated COVID-19 page on our website There you can find everything that you need to know about the potential impact of this crisis on real estate. So please stay tuned and have a look at that page. We're all experiencing tough times now due to the virus, and these are both in terms of economic, shocks, issues that we see now, but also in terms of personal situation. And I know working from home and dealing with our youngsters actually is a real life test, and it is a true balancing act. But given the situation, I really believe it's more important than ever that our industry and our members get together, get strength, I would say, from one another as we learn how best to tackle this crisis, and of course preserve value for investors. So what we're going to do today is focus on practical insights into what the market is thinking. Whether to keep the vehicles open for trading, is this a feasible solution? How do we ensure prices remain fair? Now, if you want to hear more about reporting in this uncertain times, you are also able to find a recording of the webinar that we hosted last Tuesday. Please go to the dedicated COVID-19 page on the INREV website and you can actually see that recording. Before we go into the critical areas and before I start presenting the speakers, let me just mention one more thing. We released also on Tuesday a short paper with liquidity considerations related to COVID-19. Now, together with our INREV Secondary Markets and Liquidity Committee, we have summarized in a couple of pages a relevant set of INREV guidelines and best practice that are applicable under exceptional circumstances. The other thing that we've done was to include a first preview of the open-end fund pricing work. And this is a project that we're doing together with AREF, as I mentioned, and this specifically relates to pricing policy during exceptional market circumstances. So I hope that everyone had a chance to download these papers, and if not, please do so, because this is some interesting reading. Okay, so let me start then with the speakers for today. I will start with you, Thomas. Thomas Scalabrune, he is the Managing Director at PGIM Real Estate. Thomas is based in Frankfurt, and Thomas is the chair of our INREV Secondary Markets and Liquidity Committee. Welcome, Thomas.
Thank you, Konstantin.
Thank you. Now, we have next John Ramazan. John is a partner at Audit and Advisory Services with PwC in Luxembourg. He is the immediate past chair of our INREV Reporting Committee. In case you, again, missed the reporting briefing, you can see him there. He presented last Tuesday. And John is a member of our Global Standards Steering Committee. This is an initiative that we have globally with NACRIF, PRIA, and INREV. Welcome, John. Next, we have Nick. Nick Brown. Nick is the Finance Director at M&G Real Estate. Nick is based in London. And Nick is a member of our INREV ESG Committee and also the chair of the INREV AREF focus group that has worked on the open-end fund pricing project. And
good morning, all.
Thank you, Nick. And then Robert White is a partner and real estate assurance leader with EY in Luxembourg, and he's a member of our INREV Public Affairs Committee. Welcome, everyone.
Good morning, thank you.
Okay, so let's dive right in. And Thomas, I would like to give you the floor to share a bit more insights and views regarding liquidity. How do you see the market and what we've done actually in the last few weeks with the committee? Thank you.
Thank you, Konstantin. This is, as we speak, a very important time for the European open-ended fund industry. Why? Because for the first time, this industry, which has evolved, and INREV is one of the drivers for that, so much in its harmonization, its transparency over the last 10 years, is for the first time in a crisis situation in its format, right? The last time in the GFC, the open-ended fund industry was more national, more on a country-by-country basis, and now we're talking about a young industry on a pan-European basis that's facing a moment of crisis. And this is predominantly a health situation that forces us all to speak and to work from these unusual settings and to worry about health and about the health of people we care about. But this has considerable effects on the economic situation, the pricing, and the liquidity of the underlying investments our fund invests in, and thus our underlying funds. And so it brings liquidity as a governance principle to the forefront of the debate. I mean, liquidity issues, when you talk about the governance of a fund in a normalized time or a good time, they're always a bit more on the nerdy side of governance principles compared to fees and other things. But in a crisis moment, liquidity really is key. And as Konstantin has introduced this topic, it has become key because of material uncertainty clauses in property valuations, which will be probably effective more or less across Europe for Q1 2020. And that has been the driver to ask the question, can funds remain open? Can NAVs still be published? And we've discussed this very intensively and multiple times in the Secondary Markets and Liquidity Committee at INREV, and the consensus in those discussions was, look, this time it's a bit different, because last time around liquidity issues were talked about having redemption queues. So redemptions in open-ended funds were driving gating of funds and liquidity decisions. This time around, not many redemptions are seen or yet seen. So it's actually the uncertainty and the management decision to publish NAVs that drives gating and potential suspensions. So what we want to give in the below is a bit of guidance how to go about all this and how to navigate these uncertain territories. And on this slide, which you see before you, that's the 4 main points which kind of summarize everything. Firstly, and very importantly, remaining open or suspending trading in an open-ended fund is a case-by-case management decision. This is not something that an industry association or an industry as a collective can decide. That's an individual decision that has to be made for every fund with its individual characteristics. And I'll talk about this in more detail. One important word in this is the word normally, because what we see now, and this discussion is driven by the UK, is that regulatory guidance is coming in, which should always take precedent, right? So sometimes this becomes a regulatory decision right now and not a management decision anymore. The second point is, okay, vehicles that come to the decision that they still can service redemptions and call capital and should remain open should set out appropriate disclosures to ensure full transparency and fairness on pricing to all the investor groups. And that's why Konstantin alluded to it, and you can still watch it. There was a reporting and transparency webinar 2 days ago, because disclosure, full transparency is so important in an uncertain time. And we'll go to more detail about what should be disclosed and how transparent we should be. And then thirdly, under these exceptional circumstances, there is a function that suspending trading has, and it is balancing of interests between leaving, remaining, and prospective investors. And that's what's important for the stability of a fund, and I'll also go into more detail on that. And lastly, I mean, right now, and that's also the consensus view of the Secondary Markets and Liquidity Committee, in these very uncertain times, secondary markets probably are also very illiquid. So not many transactions happening on the secondary markets at this moment in time. But we also strongly believe that over time, once the situation unfolds, active use of secondary markets can play an important role to stabilize vehicles with increased redemption requests should they come. So those are the 4 key principles we have discussed very intensively at INREV. If you could move to the next slide, please, Konstantin. So first to the question, to trade or not to trade, right? That's the reason why probably a lot of you, and there was a strong interest in this webinar with many participants, the reason why a lot of you are interested in this, because this question is asked everywhere, to trade or not to trade. And as I said, this is a management decision. It's a decision for an AIF, so a European regulated fund or fund manager. It's a management decision by the AIFM, the Alternative Investment Fund Manager, to be made based on 3 things. I mean, let's start with the practical one, and we could debate that for 2 hours. It's based on the nature and the type of the real estate portfolio and the impact of the uncertainty on the underlying real estate. Does this just impact assumptions regarding cap rates in the future? Does it impact cash flow right away? How material is it? So the nature and the type of a fund's real estate portfolio are the first driver in this decision and should always be considered. And then secondly, we are not in a situation where every fund looks the same. To the contrary, fund documentation is very specific. So what is written in your fund documentation and the governance principles in the fund and what drives them and what the rights are in there, that's the second driver to it. And that's basically the management decision, right? And then you have regulatory guidance, which is the third element. And we strongly believe at INREV that regulatory guidance should always take precedence, right? And it's probably, it's an absolute must. But if you take that out of the game, then the real estate portfolio and the fund governance are the important ones. And then if you come to the decision to remain open, which kind of is the default decision, in this uncertain environment, you should go alongside robust governance principles, right? So when is that decision revisited? How is it announced? How is it managed? And then a lot of additional disclosure on property valuations, potential pricing changes or deviations from those property valuations, and all the assumptions you used to come up with your decision and you used to come up with your pricing. So the principle of any fund remaining open in an uncertain market like this is full transparency. On the next slide, there are probably a lot of you on this call who are working with or for funds or are invested in funds that are or will be suspending. And I think for these funds, the absolute most important point in this part of the presentation is just simply saying suspensions are not a bug, they are a feature. Just to take this old proverb from the hacker scene or the IT scene, they're not a bug. They're not a fatal flaw or even a minor flaw, because suspending trading is one of the best practice governance principles to manage open-ended funds. Because inherently, real estate is an illiquid asset class if you look at the properties we invest in. So that makes funds to provide liquidity mechanisms in normal times, and that's the function of open-ended funds, but also in exceptional times, we have to deal with the illiquidity of the underlying asset base. So what are exceptional circumstances? It's conditions beyond the control of the affected party, force majeure being one of them. So this is the situation we clearly are in right now. And INREV gives a very simple guideline. Yes, suspension should be part of a fund governance for these exceptional times, and a redemption window should only be extended temporarily, so not permanently, until the shock of the crisis and its effect become manageable, and ideally by a maximum of 2 years. And we sure hope that this crisis won't last that long. And then INREV recommends the vehicle documentation to clearly define A, the nature of the exceptional circumstances, and B, how, if, how long, under what discretion to the manager, redemption windows can be extended. And this needs to be transparent in the docs. And I think the industry has evolved quite significantly over the last 10 years in that. And then it's really not a bug. And I think we all should be talking to our investors, and investors should be talking to their constituencies that it's actually a protection mechanism in a market like this. And then lastly, I've talked about transparency. What's as important is consistency. So be consistent, being consistent between the terms of the right of subscriptions and redemptions is very important. And the big question out there is whether there will be a wave of fund redemptions as an effect of this crisis or not. That's still unclear. But if there is, then obviously new capital coming into the fund, and the way to manage new subscriptions and capital going in is a very important mechanism to stabilize those funds. So should liquidity beyond uncertainty become an issue, it's very important to ensure timely and relevant information about the liquidity planning. If a vehicle stays open, there should always be a bit of a precedent to draw down committed capital to serve redemptions before doing anything else with it. And then lastly, as I've highlighted before, the active use of secondary markets can be an important stabilizer. And there should be a high degree of transparency by managers provided to investors in their fund who want to trade, but also to prospective investors who want to come in a fund and buy shares from an existing investor. So those are the general principles. With that, I would like to hand it over to Konstantin again.
Thanks, Thomas. I mean, this is very interesting and very useful. Just to remind everyone, we have the chat room there, the questions box. Please, if you have questions, submit them, and then we can then touch on these questions. So, Thomas, I mean, you mentioned the INREV guidelines, best practice. What I want to do, let me bring in John, because our guidelines, and maybe interesting for the audience, I mean, they expand across multiple modules, from reporting to INREV NAV to fees and exactly to liquidity. Which is the subject of of today's webinar. John, what are the guidelines that we can highlight for our members at this moment in terms of liquidity?
Hello, everybody. Thank you, Konstantin. So we had an extensive reporting webinar 2 days ago. I just took some of the most important guidelines here to share with you. There is nothing new. It's just a reminder of what is existing in terms of liquidity guidelines and also reporting. We will have 2 slides after regarding the reporting. So what is important to remind here is the existing guideline on redemptions of equity. So what you should absolutely disclose and discuss with your investors is to disclose the right to use discretion in setting the redemption price or the assumption adopted by other in key component of the redemption price. So here clearly we had discussion before regarding, for instance, disclaimers which are set in the external valuation report. It's extremely important to communicate with your investors if you have such a disclaimer in your external valuation report. That's a type of example you should disclose. You should disclose also all the rights deferred payment of redemption proceeds. So it's more based on your PPM. Communicate to investors without delay any change to normal practice as a result of the exercise of those rights, and provide reason. Here, obviously, the reason is this crisis. COVID-19. And in the event a manager exercises those rights, the redeeming investors should have the right to withdraw their redemption requests within a defined period. Once again, this is the guidelines. Of course, it depends on what you have in your own prospectus, but you should address at least those topics. Next slide, please. Here we are going back to the reporting. So, reporting on liquidity issue here, of course, during this exceptional market circumstances, we need to pay a lot of attention to the liquidity risks. We discussed on Tuesday market risk and credit and counterparty risk. Clearly here, there are also things to disclose regarding the robustness of your tenants and so on. But clearly, if you are an open-ended fund, if you want to continue to trade, you need to address particularly everything which is linked to liquidity risks. You need, of course, to comment about the overall financing structure of your vehicle, key financing ratios and current compliance with covenants. What we've seen now is that after the big crisis 10 years ago, the LTV is normally lower. So we do not expect to have a lot of issues currently with the LTV. And so we are in a better position than 10 years ago. And also you have to describe the vehicle overall financing income and charges. But anyway, you would have to do that also in your IFRS reporting. So we had the big discussion also around the fact to continue to compute and report INREV NAV. We are in a position, we believe that you should do it and you should continue to report your INREV NAV because anyway, the uncertainty now is about the pricing of investment properties. And this issue of pricing, you will have it anyway in your IFRS reporting or any local GAAP reporting because you need to assess the value of your investment properties. When you are using INREV NAV, the other adjustments are quite mechanical, except for maybe the DTL assessment, because the DTL split, if you are doing a kind of share deal, will depend on the conditions of the market. We know that those conditions might evolve in the future. So pay attention when you are assessing your DTL in the INREV NAV. And of course, what is important is to, and it has been already said by Thomas, but please be transparent and disclose all the assumptions you are taking. Because here, what is the most important, and it's the case when you are reporting INREV NAV, is that the manager is taking assumptions when computing the INREV NAV. What we want to do is that the investors have enough information so that if they do not agree with the assumption which has been taken by the manager, they can make their own opinion about the price of the units of a fund. So please, especially in those particular situations, be very transparent and disclose all the assumptions you are taking when you are using the INREV NAV. So I think it was for my part, Konstantin.
Yeah, thank you, John. This is very useful. And you know, next we have the Q&A slot, and questions are coming in into the chat room, which is good. So I'm, you know, going through some of them here. But Thomas, I would like to, and John as well, please feel free to chip in. I would like to start with you because I think let's put this, you know, discussion into context. I would say, what is the market sentiment now around suspensions, and what are you seeing in terms of redemptions as well? I mean, are the investors confident in the, you know, resilience of the real estate? What do you see across the board?
We obviously can't talk about any individual funds or individual situations, but talking to a lot of people right now, redemptions are not an industry phenomenon at this point. And that might change, might not change, but currently it seems that redemptions are not out there yet.
I confirm from what we see, and Robert, you can maybe confirm also, what we see in Luxembourg is that this is not the major issue for the moment. We don't see a lot of funds having big redemptions. The problem is more the uncertainty around valuation, but not redemption at the moment.
No, absolutely, and thank you very much, John. I would definitely echo that. Like, I think that there's a variety of issues that we're being presented with in waves, if you will, and I think that the topic that we're currently faced with is a valuation one, not necessarily a liquidity one. That's not to suggest that that won't come, but currently we're faced with the liquidity point. And to your question, Constantine, what I've been hearing from a variety of market participants is, of course, that there need not be this linear relationship between any potential caveat that a valuer may give and your obligation to suspend a fund. Understandably, the wish is there that in the instance where a valuer may introduce a caveat in his report, they would also include the basis of their conclusion. And that would then provide the governing bodies, be it the AIFM or the board of that particular fund, to agree with or refute that particular conclusion, i.e., examine the methodology, examine the factual inputs, examine the subjective inputs, and decide whether or not any of those components they would wish to clarify, with a view to ultimately deciding, do we suspend because we agree that there is indeed such uncertainty that it prohibits us from determining a reliable NAV, or do we believe that in fact we're privy to additional information which would put us in a position to state that this NAV is reliable and we wish to continue. I think you know, John, you made a very useful comment there, which was there's nothing new. Now, I'm sure by that comment, as with me, we don't mean to diminish any part of this issue. I think the key point is that there is already a lot of guidance in the AIFM directive, in the INREV guidelines, that if we revisit these, I think we might find that the tools are there to allow us to deal with the set of circumstances we're presented with currently.
Thank you. Thank you, Robbie. As I have you there, Robbie and John, you both are based in Luxembourg. Now we're getting some questions around, you know, regulatory insight. Essentially, let me just read one of them: suspension of tradings, any guidelines from the CSSF, and should we inform the regulators? That's one. And maybe, you know, on the UK side, actually on the UK front, I'm getting another question: how can investors deal on an NAV based on uncertain valuations? Surely if the FCA has said if funds should or not suspend. So there are a couple of questions regarding regulations and, you know, initiatives. What should the audience, you know, take from that, from the regulatory perspective?
I may start to answer, and then Robbie can maybe continue. The point here is that I saw the question about uncertainty, and what we said is that if there is a significant uncertainty, of course it's unfair, and then we would say that it's maybe wise just to suspend. But it does not apply to all type of assets. We had the discussions, if you are now having logistic with robust tenants or offices in CBD of big cities, I would say the likelihood that the uncertainty is very significant is low, okay? Now, of course, if you are dealing with large retail portfolio, that might be different. So the suspension, it's a case by case, like Thomas said before. And of course, we are not recommending to continue to trade if the uncertainty is significant. Now, it's not always the case. And if it's not the case, clearly you can continue to trade. Should you inform the regulator? Yes, of course you have to. And I think, Robbie, the regulator is sharing quite the same approach as we just discussed now.
Sure. Now, obviously, I can't speak on behalf of the regulator, but I would well imagine that they would share that view in the sense that context is king. If we are currently discussing a fund which is comprised of a hospitality portfolio, I think we'd have a pretty brief conversation. If we were discussing a fund with a portfolio comprised of logistics and CBD office, I think we would have a much longer conversation. I think the view that's shared by all is that certain things have not changed. The concept of valuing the NAV and the NAV per unit or share of a given fund is the responsibility of the AIFM and the board. Without doubt, the report of the valuer is a key component that they will rely upon, but it's just one piece of the overall body of evidence. Now, the obvious question that would beg is, well, if I'm faced with an issue where I have in my hand a valuation report which cites material uncertainty, how can I arm myself with a suitable body of evidence to refute that particular position? I would well imagine that you would follow the exact same process that you've always followed. You would work through the factual inputs, you would work through the subjective inputs, and you would work through the methodology that's been used. As mentioned also, context is king. You will consider your particular portfolio and the particular intentions and purposes of your investors in coming to a conclusion. So overall, I would imagine once the normal governance bodies are doing their role and once they're following the procedures that have been set down in their operating manuals and that's being suitably documented, that should be a relatively appropriate place to find yourself. Now, of course, we will then come on to the concept of transparency, disclosure, and inevitably that's a key thing in the current environment.
Yeah. Thank you, Robin. John, I received a question on NAV and whether people should publish that. We've already addressed it in the webinar on reporting, but let's just address it again. I mean, just clarify. I mean, the question is like, should you publish an NAV if the underlying property values are subject to material uncertainty clause?
Yes, that's what we said on Tuesday. Once again, you need to disclose the fact that your external valuer has issued a valuation with disclose, and you go to the same process. Once again, the reporting, you can report even if those clauses are mentioned, but this is the role of the AFM to review those valuations, and if they don't agree, once again, they need to tell it, they need to disclose it, to say, okay, we did not use the external valuer valuation, for instance, because of this and this and this reason, and we feel comfortable to report this valuation because of those facts. So you need to continue to report, but you need to extend, I would say, the level of disclosure you have around this reporting regarding the main assumptions you are using.
Maybe John, if I can add, say, a framework of thinking about this. Uncertainty is not a 0-1 or black and white question. I think you should treat uncertainty more as on a scale of 1 to 10. Where am I? How uncertain is this, right? And there's various things that affect this, like are cash flows directly affected? Have the valuations already factored in void periods? And I saw that was a question as well. Like some of the valuations probably already have provisions in there for the short term, right? So how uncertain is this and what's factored in already, rather than a 0-1, because the world is gray. And maybe just a little thought experiment. Would we be having discussion is if this were uncertainty on the upside? Right, we saw a couple of central bank decisions recently which provided massive upside to real estate values in the short term. Interest rate decisions. We did not have this debate. You could have argued that there was uncertainty because new capital was let into open-ended funds too cheaply, if values should actually be much higher than they were in the books. So we're having this, obviously it's normal that we're having these discussions on the downside and not on an upside, but I think it's very important to not treat it as an absolute, but as a relative thing. And then Robbie, your comment on, that's what the AIFM and their boards need to then decide. How unsecure is it and where's the threshold, which is depending on the situation of the fund.
Yeah, I would certainly agree with that, and I think that's back to the original point. I think what I've heard from pretty much every market participant is they would certainly welcome suitable transparency in their valuation reports around the basis of the conclusion in order to give them a platform from which they can form a view. This is a topic that's been scrutinized, and rightly so. And in order for us to reach appropriate conclusions, we do need to know the basis upon which conclusions have been reached.
Yeah, I totally agree with you, and this is a good discussion. One question that I want to tackle before
before we move on, can I just add to that as well? So I think we need to recognise that the experts in valuation here remain the valuers. What they're telling us is there is a bit less certainty in the valuations they can give at the moment, but they remain the experts. And the danger is that we as a profession of fund managers suddenly take that upon ourselves to come up with values. Now, Red Book values will clearly become more challenging over time as potentially evidence of actual transaction prices is removed from the market. For the time being, for many asset classes, there is still transactional evidence, and I think it's not within the will of most managers to have a constructive dialogue with their valuers to explore where the areas of tension sit in the valuation and to come to views accordingly. So yeah, I'm not sort of seeing a situation at the moment where just because a material uncertainty clause sits in a valuation, that suddenly means we can't come up with a value for the fund.
Yeah, agree. And Nick, before we move into the pricing, another exciting topic, the pricing and the fund docs and what folks should actually be aware or mindful of in the fund docs. Just a question for you and for Thomas. And I'm getting some queries around communication, and I'm sure managers are having a lot of calls at the moment, and they're exchanging a lot of information, with their investors. I mean, the question that I have is actually, how do you ensure appropriate investor communication now, but also going forward? Because, for example, the question that we got from the audience is around, it seems that using such mechanisms can lead to negative PR. What can we do as an industry? So how do you deal with that? I don't know. I will start with you, Thomas.
I think you have to distinguish the institutional and the retail world, right? The private investor funds. And if you're talking especially about the private investor funds, I think what I said earlier, that as many people in this industry and industry associations like INREV talk about the fact that this is a feature and it's not a bug. And as long as we keep on talking about it and educate the public about those protection mechanisms for illiquid investments through open-ended structures, I think that will help a lot. In the institutional world, this is more of we're in the B2B, and I know there's a lot of investors on this webinar as well, and I think there it's just like talking and as a fund manager, basically being available all the time for any question any investor has, regardless of the size of the investment, regardless of the nature of the question. It's just full and radical transparency.
I agree with that, and I think as with any challenge, I don't think you can under communicate. I think you just have to communicate with your investors as frequently, as openly and transparently as you can. Now, we know that is much more challenging with retail investors, and Thomas is right to point out that difference. I suppose within the particular world of institutional funds, that is a simpler task. We should be having educated investors who understand the issues. And frankly, the earlier and the more communication that we have with them, the better.
Yep. And just to note that this webinar and what we're discussing is specifically addressed to institutional funds. So just for the sake of clarity, this is what we're discussing now. Thank you all. We've actually extended a bit of Q&A, but let me then give you the floor, Nick, because I think it's worth sharing now a bit more about the pricing policy and about the governance around your fund docs. And again, we've done good work, great work with the INREV AREF group. This is a chapter that we've already published for you. Nick, the floor is yours. Thank you.
Thank you, Konstantin. So a quick reminder of the working group on fund pricing, which is a joint initiative by INREV and AREF. Phase 1 of that work reported in July 2018 on the effectiveness of the two principal methods used for pricing institutional funds, So that's classic dual and capitalization and amortization, or cap and am. And we concluded that both methods were effective in achieving their objectives, but they didn't produce identical outcomes for investors. Since then, we've been considering how governance over pricing can be enhanced, and we'd expected to issue our findings for consultation later in the spring. However, to aid you in pricing funds in this period of disruption, we've decided to release our findings early, given our thinking is well formed, it represents the emerging thinking on what best practice should be in the area and is relevant now. Now, the items that have been released cover exceptional market circumstances, but also include related findings on fund closures, secondary markets, and raising of new capital. We'll cover all of those this morning. The paper was distributed by INREV and sets out the major features of our recommendations. However, I would encourage you to click through using the link and review the full text and consider how those findings can be implemented within your business and funds. And I must also note these findings do not constitute codes of practice or guidelines and will be subject to consultation in the normal way. So in developing our proposals, our work is focused on protecting the investor. And this has led us to conclude that in delivering good investor outcomes, there is no one-size-fits-all solution. Instead, managers and fund boards will need to consider how to apply the principles which underlie our proposals and do so on a fund-by-fund basis. In particular, there are two overarching principles which have informed our thinking and which will be the basis for manager and fund board considerations. The first principle is that our proposals should prevail unless there are specific legal or regulatory obligations that require different actions. So very similar to what Thomas has already outlined. And those legal requirements may be contained in statute, regulation, or fund documentation. Now, statute and regulation can't be changed rapidly, but changes may be possible to fund documentation. We'd encourage managers to consider whether they need to take prompt action to update fund documentation now in order to implement proposals, or whether current documentation provides them with sufficient flexibility. It's certainly something that should be reviewed. The second principle is that when setting or adjusting pricing, action should be taken that treat investors fairly. And in particular, that means avoiding transferring value between existing, new, and exiting investors, and also across vintages. And consequently, managers and fund boards need to be analytical and broad in their thinking, as situations and circumstances will vary between funds. We're also suggesting that managers should take care to identify and manage conflicts of interest that may exist between different groups of investors and across vintages. And again, we're not being prescriptive on this, as circumstances will vary between funds. But it's really important that managers and fund boards are analysing the situations carefully and really thinking through what do they mean and what action might be taken. So turning to our specific proposals, and I think the next, right slide now. So we're proposing that managers make temporary modifications to pricing where required to avoid any unintended transfer of value between investors as a consequence of exceptional circumstances. Now, those circumstances will vary between funds, but an example is where existing investors who are redeeming are funded from existing cash or income. Those assets have to be replaced by selling assets. And in a falling market, and we're certainly seeing some evidence of that, if no adjustments are made to pricing, then a transfer of value would result between investors. And that's what we're trying to avoid. Now, there will be a wide variety of situations which need to be considered and on a case-by-case basis. So again, we haven't made recommendations on the detailed actions. It's back to fund boards and managers to think this through and to highlight what the particular issues are for their fund. Now, when an amendment is made to pricing, the sole purpose should be to bring about fair investor outcomes and ensure there is no material transfer of value between remaining and exiting or new investors. Instead, the onus is on managers and fund boards to analyse those circumstances and take action that protects the interests of all investors where possible. I really can't emphasise that enough. We're also being explicit that adjustments to pricing that represent redemption penalties and that are being used solely to manage liquidity are really not compatible with this approach. And clearly, where there are concerns that vehicles can't be priced without risking material transfers of value between investors, then regulations, guidelines and codes of practice dealing with deferral and suspension should be followed. Now, one thing that we learned in the UK when managing funds immediately post the referendum to leave the EU was that the interests of remaining and exiting investors can conflict, and that this position is not always capable of resolution while continuing to treat all investors fairly. So, for example, the act of redeeming investors may create losses for remaining investors if they are not appropriately compensated. Our conclusion was that where such a conflict exists and it's not capable of resolution, then the interests of the majority should take precedence and the managers should act accordingly. But again, this is a prime example of where statute and regulation need to be checked before acting, because that may well tell us what to do in any case. Managers should also have a consistent governance process across their platform for pricing under exceptional circumstances, a so-called house policy. Now, the purpose of this policy is to ensure consistency across investment vehicles, given many investors will have interest in more than one of a manager's funds. And it seems reasonable that they should expect the manager to be consistent wherever that's permitted by fund terms. When that's in place, it should be communicated to investors, and any change in pricing policy under exceptional circumstances should clearly follow that house policy. Now, given the need for managers to exercise judgment, the manager's actions should be scrutinised to ensure that they are proportionate to the circumstances that have been taken in the best interest of investors as a body. Consulting with investment advisory committees on matters of significance is generally encouraged. However, consulting with IACs can take time, which typically isn't available when markets are disrupted. And even where time does permit, managers need to ensure that investors represented on the IAC do not gain an unfair advantage over other investors through their access to asymmetric information. So implementing a temporary change to pricing is frequently a matter that the investment manager, management board, and any independent representatives will need to deal with on behalf of all investors and without first consulting with the IAC. Now, the fourth text of our proposals provide a helpful guide that was written for independent representatives on their duties for providing oversight of pricing. And it's also worth consideration by managers and fund boards too, as to the areas that should be looked at. And the final recommendation is that where the investment manager takes action to temporarily amend its pricing policies, it should first disclose the changes made to investors through a circular at the time the decision is made. And secondly, it should include disclosures on the impact and effectiveness of pricing changes in its next annual reporting. I'll now hand over to Robbie, who will take you through the other areas of our report that have been released early.
Thank you, Nick. Go ahead, Robbie.
Excellent. Thank you very much. Maybe, Constantine, you can bring us to the next slide. Thank you. So there were one or two additional items which we felt merited some specific guidance. To start with two of them, we speak about secondary markets, and we speak about the issue of units for less than the normal set offer price. Secondary markets is a topic we touched on a little bit earlier in today's webcast. One would imagine that there will be appetite for secondary markets in the coming weeks and months, potentially from investors who are seeking to access these products at a price that they deem to be attractive, or this may be motivated by investors who are looking to rebalance their portfolios and exit certain products at a time when funds may be suspended or deferred. The general recommendation there is that information should be disclosed on the published NAV, the quoted prices in primary markets, and any unamortized transaction costs in instances where the given fund is using the capitalization and amortization model. There should also be information given on any item included within the fund which may not be fair valued under the given financial reporting framework. And there's a list of those such as fixed rate debt, etc., and the other contingency that may have a latent value. So the overall objective there is to provide the buyer and seller with appropriate amounts of information to allow them to act in their respective best interests, and that should be facilitated by the manager and or seller. Maybe on the topic of issue of units for less than the normal set offer price, depending on the given regulation or terms of a particular offering document, there may be instances where units are issued for less than the normal set offer price, perhaps for capital projects or other items of this nature. Should such a transaction be undertaken, the concept is that existing investors should have the right of first refusal, therefore avoiding any potential dilution from the offer of these units at a lower than normal price. If the equity raise target is not reached, then third parties can subsequently be invited to subscribe. And of course, relevant disclosures should be provided to investors to enable them to fully evaluate these implications. So in both of those instances, the concept that's being proposed is ensuring that suitable information is available to allow all investors to act in their best interests, and for a manager and governing bodies to get comfortable with the fact that this has indeed been fulfilled. Moving on to our next topic, and this is a topic which inevitably we felt was necessary to provide some information on. Instances where a fund finds itself in a position where it should close, and the pricing when closing of an investment vehicle. There may be situations where a product finds itself in a situation where, in order to act in the interest of all investors collectively, or given the particular circumstance it finds itself in commercially, the best course of action is indeed to wind up the fund. The recommendations there are, of course, to include provisions so appropriate and predetermined actions to amend pricing mechanisms are possible. This speaks to, of course, the offering documents of the given funds. Some funds will have offering documents which allow them to take appropriate action in these instances. Some may not, and in those instances, of course, it is highly advisable that legal counsel is sought to ensure that the fund manager respects his or her fiduciary duty and operates within the confines set by the given statutes or regulation. The recommendation is to firstly consult with independent representatives before the decision to close a vehicle is finalized. Now, a very interesting point here is that this consultation should only be initiated once the fund has been suspended. The idea being that we want to avoid potential conflicts of interest that could be presented should one group of investors be afforded access to information that another group of investors have not been afforded. The cost of closing a vehicle should be borne by all investors, and the pricing mechanism should be adjusted as necessary to ensure this occurs, perhaps under the financial framework of the fund, or perhaps under the pricing adjustments allowed under the offering document of the fund. The general principle being that all investors who remain in the fund should equally shoulder the burden of the costs necessary to wind up that fund. And of course, this may require an adaptation of the accounting policies that have been applied previously. If you find yourself in a situation where the fund is no longer a going concern, you also find yourself in a situation where the accounting policies applied historically will need to be revisited on a case-by-case and line-by-line basis. And ultimately, inevitably, full disclosure of the investment manager's future proposal for the vehicle and proposed amendments to the pricing policy should be made available promptly to all investors when the vehicle is being closed. So ultimately, in each of these three instances, what's being proposed is thoughtful, methodical, and fully disclosed solutions to the particular situation you find yourself in.
Thank you, Robbie. I mean, these are all interesting subjects. Unfortunately, we have just a few minutes to go, and we're receiving, loads of questions from our participants. So let me just try to wrap up and actually put a few highlights on what I heard, and then I will bring everyone for some final remarks. So, I mean, because I also want to link it to the questions that we're receiving, right? So I heard from you, Thomas, suspensions are not a bug. Suspensions are a feature. And I also heard that redemptions should be extended only temporarily under exceptional circumstances. And this is a good, questions that maybe, you may answer, because I'm receiving actually quite a lot of questions around this redemptions, their redemptions, different redemptions mechanics out there. And, looking forward from your perspective, what should managers be mindful of regarding redemptions?
Again, I think this is follow the rules, right? I think this should be a rule-based approach. It's a significant part of any fund governance. So just don't change the rules in the crisis situation, but stick with what investors are expecting, because those were the rules that were around the first time. And maybe then only one second point I would make is, okay, if you suspend, make sure you already think about how to get back in. Like, so if you kind of walk out of publishing an NAV on which it can be traded, from the first minute, think about how to get back there. That's what I would add.
Yeah, thank you. And then I heard pricing, I heard, NAVs. I heard that actually, we should make sure there's a fairness around pricing, and we should balance the interest of investors. Nick, I mean, do you want to comment there? Last remarks?
Yes, I recognise this is not easy. I think many coming onto this this webinar might have hoped we were going to sit down and give them some magic bullets to use here to solve what are difficult problems. Unfortunately, we don't see them. We do think the principles that I've outlined of treating all investors fairly is the right way to go. Yes, it means as managers, as boards, we're all going to have to go and think our way through the challenges. But hopefully I've been able to outline a bit of a framework of some of the areas that need to be considered when decisions are made on both how to price, but on other actions that need to be taken as well.
Thank you. And then finally, I heard around, considerations around transparency, around disclosure. John, Robbie, final thoughts there?
Sure. I'm happy to share a few thoughts. Like I think a lot of the key points have been shared. I think we find ourselves in unique situations, but I think a lot of the tools that we need to navigate through these challenges are available under the AFM directive, under codes of best practice, under regulations and statutes that exist. I think that it's important that we follow them. I think it's important that we revisit them to ensure that we have worked through them as we should. And ultimately, I think in the interest of investors and in the interest of managers and boards, it's important that we properly disclosed how these items have been considered. So aspects of investor and financial reporting that may have been considered obscure historically, and I think, Thomas, you mentioned this point, these are now front and center. Key judgments, key estimates, liquidity analysis, items that may have not been the most attractive aspects of financial and investor reporting historically. These are now front and center and should be treated as such.
Thank you. John, final words?
I fully agree with what Robert just said. It's better to disclose too much than not enough. And please review all the guidelines, INREV guidelines, because it's a very robust framework and you have a lot of information you can use there.
Thank you. Thank you all. I mean, again, INREV is here to support. We received, a lot of questions. We'll try to come back to you separately. On that note, it's already 12 past here in Amsterdam, so I'm going to end, unfortunately, this live session, and I would like to welcome you back to another webinar session soon. So we'll be sending all attendees the materials, and you can check also the recording. Thank you again, and hope to see you soon. Goodbye now, and thank you thank you the speakers. Thank you very much for your insight. Thank you.
Thanks everyone for taking the time to listen. Thank you.
Thank you.
Bye.
Bye now.